Welcome to P2 Corporate Reporting. In this section, we are going to look at two separate areas. The first is provisions and contingencies. The second is events after the reporting date. IAS 37 governs how provisions and contingencies are recorded in corporate reports, and IAS 10 governs how events after the reporting period are covered. You've seen both of these before in F7. So I will go over a sample question or situation where you will have to apply these standards. Therefore, you should revise the F7 videos before proceeding with this video. ECO Incorporated is a multinational chemical processing company. During the financial year ended 20x7, the following happened. Due to the volatility of a new chemical, there is a 90% risk of a fire causing $1 million worth of damage, and a 10% risk of a fire causing $10 million worth of damage. Although there was no fire during the year, the finance team thinks the expense should be recognised, given that there is a certainty that there will be one. A member of staff slipped on a puddle of water and broke his spine. He can no longer do his job and has been let go from the company. At the end of 20x7, no legal claim had been lodged. However, the HR department think he will lodge a claim. Based on the accident report cert, ECO was negligent and a warning should have been placed around the spill. ECO's legal advisors believe that there is a 99% chance ECO will be found to be negligent and will be found liable for $1 million. 2 weeks after the year end was announced, one of ECO's biggest clients has gone into liquidation. At the date of the Statement of Financial Position 20x7, their balance owed was $1 million. However, the liquidators have said only 25% of the debt will be paid. This was discovered prior to finalising the financial statements. How should the following transactions be recorded in the financial statements for the year ended 20x7? Pause the video and I will go through the solution step by step. Well, it doesn't look like 20x7 went too well for ECO Incorporated, did it? Let's start with part 1. Here the company wants to provide for the cost of the fire. This is sometimes called self-insuring. They are putting money aside now for a future cost. However, to reduce a provision in the financial statements, there must be an obliging event that has occurred. An obliging event is one that creates a legal or constructive obligation, resulting in ECO having no other realistic alternative but to settle the obligation. In this situation, the obliging event would be a fire causing 1.1 million of damage. Thankfully, there was no fire at the year end, so no obliging event. So, a provision should not be recognised. Part 2. The injured employee. Now, in this situation, an obliging event has occurred. During the year, an employee was injured and the company was negligent. Based on legal advice, it is highly probable that they will be liable for $1 million. Therefore, the expense should be recognised in the financial statements for the year ended 20x7. The journals are debit legal expenses $1 million, credit provisions $1 million. A disclosure note will also be needed, explaining the details of the provision. Now, you might wonder why I am providing for an event that may not even happen. Why may it not happen? Because the employee hasn't lodged a claim. However, that is irrelevant as the employee slipped and ECO was at fault. There is an obliging event. Okay, and measuring the provision. Since the client hasn't made a claim against the company by the end of the year, ECO must make their best estimate of the cost to settle this amount. They have sought legal advice, who say that the cost to settle the obligation will be $1 million. Legal cases can go on for many years, and the value of the costs may change. Now let's take this a step further. What if the employee lodges a lawsuit against the firm in 20x8 for $2 million? His injuries were far more extensive than originally believed, and legal advice says that there is a 90% certainty that the employee will win the case. The provision was $1 million for the year ended 20x7. IAS 37 requires that provisions are remeasured annually, and at the end of 20x8, the provision should be remeasured. The extra expense recognised in the financial statements. Debit legal expenses $1 million, credit provisions $1 million. The remeasurement of an estimate is not an adjusting event. Now, what if in 20x9 the state, in an attempt to stimulate the local economy, enacts legislation that ensures all businesses' employee accidents? This legislation is retrospective and applies to this situation. Now, the company has no cost to pay. The state will cover the employee's lawsuit. Now, I know this is very unlikely, but there are circumstances where it emerges that there is no longer an obliging event or expense. In this situation in 20x9, we de-recognise the provision. Debit provisions $2 million, credit legal expenses $2 million. Again, not a prior year adjusting event. However, depending on its materiality, it may need to be disclosed in the notes. Now, finally, what about that debtor? This is a situation for IAS 10 events after the reporting period. What are the facts here? ECO had a debtor of $1 million included in their statement of financial position for 20x7. It has now come to light that this debtor is in receivership and can only pay 25% of their final debt. Therefore, $750,000 will go unpaid. This was announced 2 weeks after ECO's year end. It is so close to the year end that the debt would have been impaired at that date. However, the announcement came through a few weeks later. Look out for hints such as extended credit terms, not being able to contact debtors. These indicators show difficulties in collecting debts owed to the company and possible impairment. Since the impairment existed at year end, this is an adjusting event. The following journal is needed to adjust the 20x7 financial statements. Debit bad debt $750,000, credit debtors $750,000. You should already be quite familiar with IAS 10, but I want to talk about going concern for a moment. The accounts are prepared on the going concern principle, which is the assumption that the business will continue for 12 months after the financial statements. If there is an indication that the company will not be in business in 12 months, you cannot use the going concern principle. You must use the breakup basis of accounting. Why am I discussing this in relation to events after the reporting period? Because you must always question the going concern principle. If there is any event, even if it would be considered a non-adjusting event, but it affects the company continuing, then the accounts must be adjusted to the break-up basis. Companies may not continue for a number of reasons. The main ones that you come across are the financial or the legal issues. However, don't forget, a very successful and profitable company may also choose to cease to trade, be it that the owners want to retire, etc. This means the business is no longer a going concern. Just be aware and really look at the scenario presented. Let's just do one more example, following on from the eco example above. During 20X7, a visiting safety inspector slipped and fell. He has lodged a lawsuit for $1 million. When eco examined the incident report, it was found that the inspector slipped on wet floors that were cleaned by a cleaning company that is contracted in. The cleaning company were found to be at fault. Their insurance will cover $750,000, and due to the contract between Eco and the cleaning company, Eco is liable for the balance. Eco has sought legal advice, who have estimated that it is highly likely the inspector will win the lawsuit, but based on previous cases, there is only a 25% chance the courts will decide to award him over $750,000, and a 75% chance he will receive $700,000. Okay, so that's a wordy scenario, but you need to be able to read scenarios and pick out the important bits. What are the facts here? During the year, an inspector lodged a personal injury lawsuit against Eco for $1 million due to an accident that an outside contractor was responsible for. The best estimate of the final obligation is $700,000, which, as you heard in the question, will be covered by the cleaning company's insurance. So far, so good. However, if the lawsuit is settled for over $750,000 under the agreement between Eco and the cleaning company, Eco will be liable for the balance. So what is this? If you said contingent liability, you are right. A contingent liability is a possible obligation depending on whether some uncertain future event occurs, or a present obligation but payment is not probable or the amount cannot be measured reliably. And how do we record it in the financial statements? There is a 25% chance that Eco will be liable for some of the lawsuit payment. This is a contingent liability with a possible chance of Eco having to pay. Therefore, no provision should be recognised. However, it should be disclosed in the notes of the financial statements. It might have been a while since you studied F7, so I just want to quickly discuss another exposure draft of IAS 37. Although its deadline was in 2005, a very long time ago, but finally it was considered for a longer term research project. The ultimate result of this ED with respect to IAS 37 was that contingent liabilities needed to be treated more consistently. The term contingent liability will not be used. This is because liabilities arise only from unconditional or non-contingent obligations. This means that provisions are unconditional obligations that establish that there is a liability, and contingent liabilities are conditional obligations. Okay, I have given a quick recap of provisions and contingencies and events after the reporting date. However, like all the standards, it is a question that can be asked in so many ways. So, my advice is to practice questions. Thank you.